sideways movement for the market continues. Yesterday was a much narrower band than you had day before as well. We were, I think, trotting around maximum in about a 60, 70 odd point band from the highs to the lows of the day. Picked up a little bit towards the dying minutes of the session yesterday, but nothing meaningful really. But yes, this morning, you've not got a supremely charged up global screen, but definitely names like nvidia are the ones which are popping out, because that has issued a very strong forecast. The numbers have been very strong. The stock is now above $1,000 per share, and there's a stock split announcement as well. So yeah, while not a great looking global screen, but definitely great earnings.
Global cues, I would say status quo.
Yeah.
FOMC, inflation is sticky, rate cuts cannot be assumed. Rate hikes are certainly out of the window. So nothing new has come from FOMC. Nvidia, the world knew that they would be in a good, earnings curve, so to speak, and they surprised everybody. What we are not talking about is the following. Crude. Where is crude? It's at 83. 83 last when I checked in the morning. And crude coming down to 83, I think, is something which is getting unnoticed. One side we are talking about rally in metals. One side we are talking about gains which are coming in some of the precious metals. But this entire risk-on trade is not really having a very large impact on oil per se. So there is no big move which is there in the energy complex, and which is what really matters to India eventually, that where the energy complex is moving. So that's something which is good. The handover from US market may not be that charged up, but there's nothing wrong with it. Global markets are firm. They are not far away from an all-time high. Fed commentary or Fed FOMC minutes pretty much say the obvious. And in terms of the SGX, looks like we are in for a flat start. That's a global sum and summary of where we stand.
Yeah. And it's really a status quo from the FOMC minutes as well. The takeaways from their recent meet saying that inflation is persistent, higher than expected, lack of further progress towards that 2% inflation target, and very categorically saying can tighten further should inflation risks materialize. So pretty much throwing that rate cut out of the window. It seems like it's going to be a pause for longer right now.
Yep, that seems to be the commentary coming out of the US. But if we were to just, do a status check on the trader screen back home and how the trading session panned out yesterday, it was pretty much status quo as well. It was a flattish day of trade with a positive bias, minus, of course, what happened with the small cap end of the market. So that's what we're looking at. Short covering when it comes to the F&O position. The net flows have been fairly positive, and you've got the global cues as well, the handover that's decent. The fact that there have been no sharp moves on the volatility index, we're over 1% away, or less than 1% away rather, from those life highs. And Nikunj, the FII selling, while it is continuing, it has abated to sub 1,000 crores.
See, Avan, just look at the price action. And the price action in individual stocks, I think, is more than satisfactory. Defense, railways, few specific corporate groups, anything which has got to do with infrastructure, that pocket in a sense is looking charged up. Now, whether it is a combination of railway stocks, whether it's a combination of defense stocks, or whether it is a combination of the entire infrastructure chain per se, I think that pocket in a sense is looking charged up. B, there is evidence of no fresh selling. That is what the F&O data is indicating, very important, which means that let's say in middle of May, we saw huge amount of short selling, and that short selling now is no longer evident. Short covering, I think, is evident. That screen captures it in a very nice manner. But for me, I think this is the sum and summary of the market stack up. Two extremes, right? FI short at a record high, retail and DI long at an all-time high. So you're staring at actually two parallel markets, and that is a judgment call on how one should position themselves, basing on the risk. But I've never seen this kind of a divided, construct ahead of election. So retail positioning all-time high, FI positioning at a 10-year low. So how do you really bet on the market cycle? I would say that it's time to start thinking differently. Rather than saying if there is continuity, which it appears and which is what markets are betting on, do you continue to really be or continue to ride the momentum in defense, PSU, railways, which is the most obvious trade? Or you say, okay, FIs have been selling. They've been selling because of the event risk. They will only come back after the event risk is over. what are the
will
chances that
come
they will
back in
come
large
back?
caps.
And they will
Yeah.
come back in large cap. So do you buy large cap FI dominated stocks, or do you stay with what is the local
Momentum.
crowd cheering for? So do you want to be contra here, or you want to be part of the crowd?
That's going to be very tricky, actually.
I think.
I mean, looking at their appetite, they will have no option but to get into the prized Nifty 50 names.
Yeah, so they may be selling for a reason. See, everybody has an individual risk management and what your view in terms of assessment of the country is. But the compulsions, when they are at play, then you're forced to buy, irrespective of what your view on the valuations is. So I'm of the view, and this could be completely wrong, but I'm of the view that rather than being with the crowd, which is infra, railway, defense, rather than being with the cheery consensus, time to think slightly contra. Your downside in these stocks is limited, right? But your upside actually could be strong. Why? Because when the short covering becomes buying, when the trade reverses, that's time maximum gains are registered.
Yeah, it seems likely that perhaps they're going to take a contra view. One will have to only wait and watch. There is, of course, that big event that we have, watching out for what could potentially happen with the election results. All right, let's get a move on then and also take stock of the record dividend that the RBI has paid, 2.1 lakh crores to the government in FY23 at a sum of 87,000 crores. This has seen a sizable jump up, and Nikunj, just mapping out the kind of transfer trend that we've witnessed in the election years, this number definitely stands out, and the 10-year bond yield quoting at about 6.9%.
Okay, now first you would ask yourself, oh my God, what is this? Why has Reserve Bank of India given such a large dividend? And do they have the balance sheet strength to give this kind of a dividend? What compulsion was at play, or this is something which Reserve Bank of India can really digest, and they have given dividend purely based on the strength of the balance sheet? I think the latter is at play. So where is Reserve Bank of India? See, Reserve Bank of India also has a balance sheet like a company in which they make investments and they benefit because of their investments in bonds and because of their forex reserve and forex currency intervention. So it is profit what they've generated, in which is what they are giving out in form of a dividend. Now this dividend is much, much, much higher than what everybody was expecting and anticipated. Now when the money comes into the government kitty, what will that do? That will give government ability to spend. Fiscal deficit, which in a sense is not a concern, but the fiscal deficit number will suddenly start looking better. And see, this in a sense just gives government more ability now to plan big and to spend big. There are pockets in the economy which do need government support. I think this money could move there. B, if the fiscal deficit comes down and if government is spending is likely to increase, then on the expenditure front, which is the government have been spending, I think you will see mega projects. You may see some announcements in the first 100 days if the government comes back, because now they have a buffer. But more importantly, from a capital market standpoint, the liquidity condition in the market will come down, will increase. Yields will come down, liquidity will increase, which means the pressure which the banking system has gone through because of lack of liquidity, that also gets better. So it's a wonderful surprise. It's like nobody was expecting something like this. Imagine it's your birthday and you get a wonderful surprise. It's like one of those things which you've got.
Always welcome.
Yeah, it's a welcome surprise, and you got to just applaud Reserve Bank of India the way they manage their balance sheet in this kind of a tricky global environment with the forex reserve, without taking any risk, taking care of the capital buffers. They've given such a fat dividend. It's not arm twisting, it is real hard work which is paying off.
If you like this video, then like, share and subscribe to ET Now.